Hey, it's Tom here and welcome back to the channel. Now, this has been a very big week for Netflix investors. We had Netflix come out and report their first quarter 2022 earnings, as well as providing some updated guidance for the Netflix business moving forward. And the market really did not like the earnings update from Netflix. At one point during this week, the stock price was down 35% in a single day. And to my surprise, very quickly after those earnings results came out, we actually also had a press release out of Pershing Square, which is Bill Ackman's fund, his money management vehicle, I guess. And after only investing in Netflix in late January, Bill Ackman has actually turned around and fully exited the Netflix position. He's sold all the shares that he owns through Pershing Square, and it's really interesting, I think, as a case study to read through some of the initial reasons why Bill Ackman got into Netflix and also some of the updated reasons why he has now gotten out. So in this video, I want to give some of the results that actually came out of Netflix, which were effectively slower revenue growth and projecting slower growth moving forward, and some of the reasons why they think that's happening and kind of what Netflix investors should expect moving forward. And secondly, I want to talk through what Bill Ackman actually came out and said initially in January when he made his investment in Netflix, and more recently what he thinks has changed in the story and caused him to sell. Now, if you want kind of my personal thoughts on Netflix as a business and a potential investment case, I won't be covering that in a huge amount of detail in this video, but I was recently on the Young Investors podcast with Brandon from the New Money YouTube channel and also Hamish Hodder from the Hamish Hodder YouTube channel. So that podcast with Brandon and Hamish has just been released as I'm recording this video, so I will leave it linked down in the description below if you want to check out a video version. It's called the Young Investors podcast if you want to search that up on audio platforms as well. But without further ado, let's get straight into the video with an update from Netflix and also Bill Ackman. Okay, so I'm going to start off with the shareholder letter from Netflix. And the shareholder letter basically gives sort of 4 reasons why Netflix thinks their revenue has, or revenue growth at least, has started to slow. And it also gives some of the kind of stats in terms of subscriber numbers and revenue and so on. So let's start there. And the shareholder letter begins by saying, our revenue growth has slowed considerably as our results and forecasts below show. Streaming is winning over linear as we predicted, and Netflix titles are very popular globally. However, our relatively high household penetration, when including the large number of household sharing accounts, combined with competition, is creating revenue growth headwinds. The big COVID boost to streaming obscured the picture until recently. While we work to re-accelerate our revenue growth through improvements to our service and more effective monetization of multi-household sharing, we'll be holding our operating margin at about 20%. Key to our success has been our ability to create amazing entertainment from all around the world, present it in highly personalized ways, and win more viewing than our competitors. These are Netflix's core strengths and competitive advantages. Together with our strong profitability, we believe we have the foundation from which we can both significantly improve and better monetize our service longer term. And if we look through some of the core kind of business results for the first quarter of 2022, this is where basically those figures came in at. So year-over-year growth in revenue was up 9.8% for the first quarter of 2022 versus the first quarter of 2021. Operating income came in at 1.972 billion, operating margin of 25.1%, net income of 1.6 billion, and earnings per share of $3.53 per share. Now, the bit that really caught a lot of Netflix investors by surprise is actually this next part. So global streaming paid memberships, basically Netflix subscribers, it's a figure that Netflix investors clearly pay a lot of attention to. The Netflix business model is reasonably straightforward. It's how many subscribers do you have and what price are those subscribers paying, basically. And the subscriber number actually shrunk from last quarter for the first time in Netflix's history. Now, there's an important caveat to that, which I will get to in a sec, but the numbers came in at 221.64 million global streaming paid subscribers versus the previous quarter, so fourth quarter 2021, it was 221.84 million. So they've lost about 200,000 subscribers since the fourth quarter of 2021. And I think the part of this that actually surprised Netflix investors even more was the guidance that Netflix gave for subscriber numbers next quarter. So for Q2 2022, they guided to have 219.64 million paid memberships, which would be a decrease in subscribers of 2 million for the next quarter. Now, firstly, let's touch on the important caveat for the decrease in subscribers for the first quarter of 2022, where they've lost 200,000 subscribers. A lot of that is basically to do with Netflix pulling out of Russia. So they've completely stopped kind of their streaming services in Russia, and that had a negative 700,000 subscriber impact on the business. So you've lost 700,000 from Russia. They've lost 200,000 overall for the quarter. So that means if you kind of adjust for Russia, they've actually grown subscriber numbers by about 500,000 in the first quarter. So that is a very important note when you're looking at those subscriber numbers. And this is the commentary they gave on that sort of 2 million subscriber decrease for next quarter. So they said, as a reminder, the quarterly guidance we provide is our actual internal forecast at the time we report. For the second quarter of 2022, we forecast paid net additions of negative 2 million versus 1.5 million in the year ago quarter. Our forecast assumes that our current trends persist, such as slow acquisition and the near-term impact of price changes, plus typical seasonality. Q2 paid net adds are usually less than Q1 paid net adds. We project revenue to grow approximately 10% year over year in Q2, assuming roughly a mid to high single digit year over year increase in average revenue per membership on a foreign exchange neutral basis. We still target a 19 to 20% operating margin for the full year 2022, assuming no material swings in foreign exchange rates from when we set this goal in January of 2022. So an important note there is that, yes, Netflix do expect to have some struggles, I guess, in terms of growing their subscriber base in the immediate future, but they do still expect revenue to grow, and that is basically a function of price increases. So, like I said, business model at Netflix is pretty straightforward, at least in terms of how they generate revenue. You have a certain number of subscribers and you have a certain price per subscription, and I would argue that Netflix still have a fair amount of wiggle room to keep pushing that kind of price per subscription up, particularly if you consider just how kind of penetrated their business is in the US, which is more or less, if you account for household sharing, which they do get into in the shareholder letter, you've got very, very high penetration rates in the US. Like it might as well be every household that has an internet connection. It's not quite that extreme, but it's getting pretty close to that level. Okay, now before we get into what Bill Ackman did with his investment in Netflix and what he kind of said about exiting the position, let's very quickly walk through the 4 factors that Netflix described that they think is starting to impact their revenue growth. So they said, first, it's increasingly clear that the pace of growth in our underlying addressable market, broadband homes, is partly dependent on factors we don't directly control, like the uptake of connected TVs, the adoption of on-demand entertainment and data costs. We believe these factors will keep improving over time so that all broadband households will be potential Netflix customers. Second, in addition to our 222 million paying households, we estimate that Netflix has been shared with over 100 million households, including over 30 million in the US and Canada region. Account sharing as a percentage of our paying membership hasn't changed much over the years, but coupled with the first factor means it's harder to grow membership in many markets, an issue that was obscured by our COVID growth. Third, competition for viewing with linear TV as well as YouTube, Amazon and Hulu has been robust for the last 15 years. However, over the last 3 years, as traditional entertainment companies realized streaming is the future, many new streaming services have also launched. While our US television viewing share, for example, has been steadily up according to Nielsen, we want to grow that share faster. Higher view share is an indicator of higher satisfaction, which supports higher retention and revenue. And fourth, macro factors including sluggish economic growth, increasing inflation, geopolitical events such as Russia's invasion of Ukraine, and some continued disruption from COVID are likely having an impact as well. Now, if you then go on to listen to the conference call that Netflix did, which I would definitely recommend listening to if you have any interest in potentially investing in Netflix, and particularly as the price has gone down. I don't personally have a position in Netflix. don't buy or sell it just because I'm saying things. Do your own work on it. But in the conference call, they did say a couple of things that were quite interesting. So firstly, they mentioned that they've never really been that worried about household sharing of passwords and things. They felt that it was actually quite a good marketing tool for people to get some initial exposure to Netflix and then potentially go on to subscribe themselves when they no longer have access to a friend's password or whatever. But now they're getting to the point where that account sharing is really limiting their growth. If you include the estimated number of households that are kind of borrowing passwords, there's really not a whole lot of total addressable market left to grow into. So that's something that they're interested in potentially cracking down on, although there are some substantial challenges with actually verifying like who's a family member and who's not. And it's interesting to get some management commentary on that, so I definitely go and recommend checking out that conference call. And the other thing that they kind of just floated the idea of, which Reed Hastings, the CEO, says he's never particularly been a fan of, but he's a bigger fan of consumer choice basically, and that was potentially looking at bringing out a Netflix subscription tier option that actually has advertising, and that would be at a cheaper price than the traditional Netflix subscription. He said that's probably not something that's going to be out at least within the next 1 or 2 years, but it is an option that they're looking at as well. Okay, now for the second part of this video, like I say, I want to take a look at basically what Bill Ackman has said about Netflix. I will cover a few of his points from his shareholder letter in January when he first made a position in Netflix. And we will kind of cover what he has said in a recent update about why he has turned around and sold Netflix. Now, time, of course, will tell whether this was a good decision or a poor decision for Bill Ackman, but I think it's a really interesting case study of kind of Bill Ackman really wanting to focus on highly predictable businesses and basically positioning himself accordingly in his portfolio. You may or may not agree with what he's done, but it's certainly an interesting case study. So let's go back to his letter from the 26th of January 2022, where he described Netflix's business has highly favorable characteristics, and he gave kind of a list of the reasons why he was getting invested. So he said it's subscription-based, highly recurring revenues which have enormous future growth potential, a truly best-in-class management team and unique high-performance culture, economies of scale and superb quality in its industry-leading content which should continue to drive future growth and widen the company's powerful competitive moat, pricing power derived from the enormous value it delivers to consumers compared with other alternatives, substantial margin expansion with the opportunity for continued improvement due to economies of scale and the company's rapidly growing global subscriber base, and finally, an improving free cash flow profile which should allow for continued investments and growth as well as the return of cash to shareholders. So, what changed with Netflix? Now, this is what Bill Ackman had to say in his most recent update on the 20th of April 2022. And as usual, all of these press releases and shareholder letters and things will be linked down in the description below. So, Bill Ackman said, today we sold our investment in Netflix, which we purchased earlier this year. The loss on our investment reduced Pershing Square's year-to-date returns by 4 percentage points. Reflecting this loss as of today's close, the Pershing Square funds are down approximately 2% year to date. While we have high regard for Netflix's management and the remarkable company they have built, in light of the enormous operating leverage inherent in the company's business model, changes in the company's future subscriber growth can have an outsized impact on our estimate of intrinsic value. In our original analysis, we viewed this operating leverage favorably due to our long-term growth expectations for the company. Yesterday, in response to continued disappointing customer subscriber growth, Netflix announced that it would modify its subscription-only model to be more aggressive in going after non-paying customers and to incorporate advertising, an approach that management estimates would take 1 to 2 years to implement. While we believe these business model changes are sensible, it's extremely difficult to predict their impact on the company's long-term subscriber growth, future revenues, operating margins, and capital intensity. We require a high degree of predictability in the businesses in which we invest due to the highly concentrated nature of our portfolio. While Netflix's business is fundamentally simple to understand, in light of recent events, we have lost confidence in our ability to predict the company's future prospects with a sufficient degree of certainty. Based on management's track record, we would not be surprised to see Netflix continue to be a highly successful company and an excellent investment from its current market value. That said, we believe the dispersion of outcomes has widened to a sufficiently large extent that it's challenging for the company to meet our requirements for a core holding. One of our learnings from past mistakes is to act promptly when we discover new information about an investment that is inconsistent with our original thesis. That is why we did so here. We are in the midst of an opportunity-rich environment for Pershing Square due to the dramatic shift in Federal Reserve policy, the highly inflationary environment, geopolitical uncertainty, and the resulting high degree of security price volatility. We therefore expect to find a good use for the Netflix proceeds. So for me, two really interesting takeaways from that letter from Bill Ackman. The first thing that he really highlights is operational leverage, and the second thing that he really highlights is basically uncertainty. Now, in terms of operational leverage, this is something I've been thinking of doing a video on actually recently, so if you're keen to see me do a more detailed video on operational leverage, definitely let me know. But operational leverage is essentially the idea that if revenue grows or if revenue shrinks, the profitability of the business moves to a much greater degree. So if revenue goes up 5%, for example, earnings might go up 15%. And if revenue drops 5%, maybe earnings go down 20%. You're kind of leveraged to whatever the operations of the business are bringing in terms of revenue. And this is very typical to see in a lot of kind of subscription-based businesses where you have a large kind of fixed cost base. There's not a huge amount you can do to move those costs significantly up or down year to year, and you kind of get to a point where every new subscription coming in the door is essentially kind of pure profit. So that can really dramatically improve margins and provide operating leverage, as Bill Ackman described it. So small changes in future growth for Netflix and the revenue that's coming in the top line can have an outsized effect, as he described it, on the earnings and intrinsic value of the business. So that's something that really stands out to me. Personally, as a Netflix subscriber, I've just I see the money just disappear from my bank account every month, and it's probably one of the last things I would cancel. I don't often watch like standard TV anymore. I kind of just watch Netflix and YouTube and things. So for me, I'm definitely a sticky customer, and if the price goes up, I probably won't cancel, if I'm being perfectly honest with myself. But that's just me. Perhaps it's becoming clearer that other people don't have that same attitude to Netflix, but I'd potentially also argue that if Netflix isn't a sticky product, then what should we expect to happen to basically every other consumer business on the planet? I would argue Netflix is one of the stickier products up there. But that was kind of the first point from Bill Ackman. The second one is uncertainty and just a wider range of outcomes than we've had before. And investment is very much kind of a probabilistic exercise. There is never certainty when you make an investment, unless you're investing in a government bond or something where they can print money and never go bankrupt and all that sort of stuff. Anytime you're investing in a company, which is what you're doing when you buy a stock, there is a degree of uncertainty, and there are a range of outcomes, each with varying probabilities, and your job as an investment analyst is to try and get a handle on what is the probability of each of those outcomes. How much will I lose in the bad outcomes? How much will I make in the good outcomes? And if you're comfortable that you can assess those odds with a degree of certainty, and you're comfortable that the risk reward is attractive, then you will make the investment. That is how Bill Ackman is clearly thinking about it. As I understand it, that's exactly how Warren Buffett and Charlie Munger think about investment. And we've also seen people like Monish Pabrai talk about that approach to investment as well, where if the downside is limited, the upside kind of tends to take care of itself. So clearly, due to the slower growth from Netflix, Bill Ackman thinks that the odds have changed, and they've changed to a significant enough extent to where he is basically exiting Netflix, having learnt from potentially some prior mistakes that he may have just held on to a business too long and it really didn't work out well. So that's it from me for this one. Definitely let me know your thoughts on the Netflix update, whether it's a business you're getting interested in or whether it's something you're just not interested in at all. And let me know your thoughts on Bill Ackman's kind of change of attitude towards Netflix as well down in the comments below. So that is really it for me for this one. I do hope you enjoyed the video. If you did, please hit like and also subscribe to the channel if you are new here, and I will see you in the next video. Cheers.